Hello and good morning, folks. Welcome back to Almus Market Mornings, where we look to bring all the sorts of narratives that are governing the financial markets. With me, Shikhar Garg. Now, talk about narratives. I like how the reason for the crippling economy and high inflations has been completely shifted to the over reliance on cheap energy instead of the excessive easy policy and the numerous stimulus packages that we saw in the past couple of years. And not just that, there's also a lot of difference in the policies adopted by the two major influencers of the economy, the central banks and the government. So there's a lot of discussions going on around how to prop up the economy while curbing the inflation. So JK, what's going on? What should we be expecting out of the Jackson Hole event, where the central banks are going to discuss on the same front, and how would that impact our financial markets?
Yeah, good morning. Definitely, markets and investors are sitting on their hands ahead of the key events today and tomorrow. Today we have the GDP number. Tomorrow we have core PC inflation and followed by Powell's speech. Actually, Jackson Hole meeting starts today and goes on for 3 days. And the most important and awaited event is Powell's speech, which is scheduled tomorrow. And the interest is surrounding how he would sound, whether he is going to toe a hawkish line in view of the persistent inflation, and also the fact that the financial conditions have still remained easy, which they want to avoid, because that gives rise to higher demand and further inflation. So or whether he will follow a middle path of giving a cautiously hawkish stance, because the economy is also slowing down. So a lot of interest surrounding that, and I think till then the moves in the markets are basically position driven. But definitely bond markets have been more volatile than other markets, like currencies and stocks. And yields on German and US benchmark 10-year yields rose to 8-week highs yesterday. In fact, UK's short-dated bond yields also hit 14-year highs. The main driver has been energy prices in Europe, which has raised higher inflation in Germany and Britain. And this is even likely to raise the bets on how much Fed will raise in September, because eventually the higher gas prices in Europe is also having its impact on the prices in the US. The expectation on September hike is again swinging between 50 and 75 basis points. Now it is at 60% for 75 basis points. Importantly, expected peak in Fed funds rate is now at 3.8 versus 3.62 for a fortnight ago. And a cut in 2023, which had been priced for 51 BPs a fortnight ago, is now at 37 BPs. But that is something that we really need to wait and watch. In Europe, the energy situation looks dire, with gas prices soaring another 10% yesterday on the benchmark Dutch DTF, and importantly, that backdrop is slowly feeding on to US, as I already said. And Europe sees higher inflation, keeping their expectation of rate hikes much elevated. In fact, now Bank of England is expected to take their final rate up to 4.4, which is higher than 3.8 for the US. And that move has been reflected in the yields of UK 2-year yield, which is 22 basis points up at 2.9%. And of course, there will be a measured move by Eurozone. Again, the target rate there is at 2%. So all in all, a lot of focus on where the yields are moving and where the terminal rates would be. In stock market, they were moving more with corporate news than with economic news. Durable goods orders month on month came a bit weak, but that's not a major market mover anyway, and it's a very volatile series, so market did not move much with it. FX has been relatively quiet. Dollar index not moving much, of course, and European yields have driven higher, and that slightly supported the euro, which is finding a base around 9910 for the time being. Interestingly, I am hearing quite a few central banks somewhere indirectly expressing unpleasure at the current state of the FX market. Chinese authorities are reportedly checking with their banks about whether and why they are selling big amounts of yuan against the dollar. Then there is a report of a stealth intervention in dollar yen through semi-government institutions. So you can see the dollar yen is finding it difficult to go above 127.20 despite US yields going up so much. So important to note. And then today, Korean authorities, by raising 0.25% their policy rate, simultaneously said that the hike in the rate would probably check the decline in the Korean won. So this is probably getting into a stage where authorities are not liking the way currencies are moving. We have not heard much from Europe or UK. I'm sure people will be looking out for any statements from them. But all in all, quite in FX market, dollar rupee yesterday tended to strengthen a bit because of reported flows from some tech companies, and it slowly started to track the dollar index moves. And probably today we'll have a slightly better opening for the rupee. And definitely we don't see much larger move ahead of the key event tomorrow. So keep yourself engaged in more on expectations post Jackson rather than getting into some short-term trading and better focus on risk management. Thank you.
Okay, wonderful, JK. And I'd like to highlight how we've been tracking few data points. The German bonds saw the yields rise to an 8-week high, while the peak for the Fed fund rates is now higher at 3.8% as against the 3.6% expected. Another major driver for inflation on all these crippling of economy is the gas prices, which are soaring even further, and there's no respite seen in the pricing of energy, be it gas or otherwise oil and other methods. But there was also something quite interesting seen, a stealth intervention by the semi-government companies in China, as JK mentioned, which is extremely opposite to the actions by the US government. US government seems to be still working around with the stimulus packages, as we recently heard Biden government working towards waiver of student loans. So at one point, central banks are trying to curb inflation, while on the other hand, US government is continuing with their policies, which can further pump up some bit of inflation, as the economists are seeing.
Shikhar, this student loan waiver can lead to 244 billion drain on the government revenue. That's the report.
Interesting. So further drain, and also economists are expecting it can push inflation by another 20 to 30 basis points.
Yes.
Quite an interesting set of actions, and extremely opposite actions when it compared to the central bank. It's actually now that's where we see the game theory playing in, and who's the major force in attempting at the objectives. So let's see how things go by. Interesting times ahead for us. We'll bring in further updates, all majorly from the Jackson Hole Symposium. That's everyone waiting for. That's it for today. Thank you so much for listening.